good afternoon or good morning, wherever you are, and welcome to our webinar. It's the third webinar in our digital project practice series, Transform Ideas into Innovations. Today we have Jibran Ahmed with us. He is the Senior Director at Agoda and their Head of Fintech and Business Initiatives. He is also a doctoral student at the Asian Institute of Technology, and that's the reason why we invited him today for our webinar. He is also a co-author of the book series Digital Project Practice. And before I hand over to him, just two words about this book series, Digital Project Practice. We cover there various topics about project management, digital transformation, and topics in that wider field. We have now published already 3 books in this series. The first one is Digital Project Practice, Managing Innovation and Change. The second one is Digital Project Practice for New Work and Industry 4. And now the latest one, Digital Project Practice for Banking and Fintech. And Jibran contributed a chapter to this wonderful book, which we will dig in a little deeper today. But before we go to embedded finance, I use this opportunity to share with you that I can convince the publisher to give us a discount code. So if you are interested in that book, then you can order it on the publisher website with the code that I just pasted in the chat. So you have that information available. And we also have a group on LinkedIn. So if you want to engage in the discussion, so obviously we will also have some discussion and Q&A today in the chat. But if you want to continue with this, or if you want to stay updated on latest environments, so please join our group with the link here or scan the QR code and then join our Digital Project Practice group on LinkedIn. But now, without any further ado, Jibran, welcome. It's great to have you here today. And we are all very keen to learn more about embedded finance and how to make it invisible.
All right. Thank you very much for having me. Can everyone hear me okay? Audio good? Okay, awesome. Give me 10 seconds while I share my screen. And I think you should be able to see my slides now. Okay. Good morning, good afternoon, good evening, everyone, based on where you are. Thank you very much for joining this session. As Dr. Tobias introduced, my name is Jibran. I am Head of Fintech and Business Initiatives at Agoda, which, if you don't know, is an online travel agency, a global online travel agency with a strong footprint in APAC. I'm based in Bangkok, and I lead the fintech business function for Agoda globally. In addition, I am a doctoral student at the Asian Institute of Technology, and my thesis is based on embedded finance, for which I work closely with Dr. Tobias. So today, it's my pleasure to walk you through what is embedded finance, how is it responsible for making finance invisible, and perhaps we can have an educated discussion on what it means and why it's important. So embedded finance, maybe let's get started with some quick background, right? So why did I get into this? Since I joined the fintech industry, embedded finance has always been a big buzzword. You hear it a lot. You go to big conferences, you talk to big payment companies or fintech companies. Embedded finance is something you hear about a lot. Or even if you just look up research reports on the fintech industry by big companies like McKinsey or BCG or Accenture, you'll find this word embedded finance and how it's going to transform the world of financial services over the next 10 to 15 years. So that piqued my interest. Second, as I started working for a global e-commerce platform focused on travel, I started to overlap a bit more with the embedded finance universe, which, as you'll see in a couple of slides, is very core to what global platforms are doing or should be looking at in the future. And so that's what brought me to the world of embedded finance. Some quick facts to give you guys an idea of why this is seen as an important subject. So if you look at some research reports on fintech, they will point out that embedded finance is one of the fastest growing segments of fintech. It's projected that it already generates about $22 billion of revenue, which is quite significant as is, but that is expected to more than double by 2026, which should tell you about the growth prospects of this specific industry. And also, if you look at some of the research that looks at online interest on Google in the term, this is one of the fastest growing list of terms that's searched online by consumers. So something that's coming up very fast. Within embedded finance, there's a bunch of components. So if you look at some of the industry research, it says that payments, specifically consumer payments, will be the fastest growing or the largest part of the pie by 2026, followed by consumer lending, and then a bit about B2B payments, business lending, and then you have other streams which we'll talk about later. As I got into this, I found that despite significant presence in the industry, $22 billion of revenue, and significant growth prospects for most industry reports, and growing interest, there isn't a lot of academic research on this. So if you go to Google Scholar or if you open any of the major mainstream fintech journals, you won't find a lot of academic peer-reviewed research about embedded finance. What you do have is a lot of practitioner research, industry research, and white papers, mainly from the companies that are now engaged in this particular industry. And so that presented an academic opportunity for me as a doctoral student to also get into the theoretical aspect of this. So that's the background. Moving on, what really piqued my interest is that while there's a lot of interest in embedded finance, there isn't a very, very clear definition of what embedded finance is. I was at a conference called Money 2020 Asia about 2 months ago, which happened incidentally in Bangkok, where you get people and companies from pretty much all over the world, heads of companies, CEOs, fintech leaders, thought leaders. And I attended a session specifically focused on embedded finance with the gigantic audience, where 3 company leaders talked about what embedded finance is going to become in the next few years. But I asked people on my right and on my left, do you know what embedded finance is? And none of them could tell me what it was. They just knew it's going to be big, and they just understood that it generates a lot of interest. So that's why one of the focus areas for my research initially became how to produce a definition of embedded finance that's consistent and that can potentially be used for my research. Before I get to that, maybe just providing a quick primer from the industry, right? So embedded finance can fall into several categories. I'll go through one by one. It could be under payments. So for example, when you go to a platform like eBay or Amazon or Agoda or Booking.com or Lazada or Shopee, and you are using payment methods embedded into the checkout page of those platforms, you're essentially using embedded finance. That's payments as an embedded finance service offered at the checkout pages of those platforms. Similarly, if you've ever bought something online using a buy now, pay later solution offered by companies like Klarna, Affirm, Affinity. Here in Asia, there's a big company called Atome. In Singapore, that does it. So if you bought something online on some of these same platforms using a buy now, pay later method, that's embedded finance. If, for example, you've ever bought a product online that allows you coverage in exchange for pricing for a future event, you've essentially bought embedded insurance. A good example of this, for example, from a travel use case is if you buy a hotel reservation with a slightly more expensive price, but which allows you to cancel it for any reason and allows you to plan around your travel needs, that's essentially building an insurance option into the platform without actually you buying travel insurance. And so that's an example of embedded finance. There's also recent examples where online platforms have started to take customer deposits. You can actually pay up a certain deposit, which in certain cases can give you a rate of return. And as your deposit builds up, you can eventually use that to make a purchase online. It's sort of summarized under a term called save now, buy later, which started in the UK and is now coming more and more into Asia. That's an example of embedded finance. And then finally, a whole bunch of these platforms are in the initial stages of looking at offering investments and trading solutions on their platforms. And that's also an example of embedded finance. So it's something that you see a lot around you, and perhaps you even transact using an embedded finance solution. But it's fragmented, and oftentimes we don't really notice that when we're engaging with some of these platforms, they're buying financial services. And that's where the invisible part of embedded finance comes in, which I'll talk a bit more later. So getting into a few basics, right? So as we try and understand what embedded finance is, it's good to look at the evolution of the banking model or how financial services evolve. So traditional finances, if you're a customer and you're looking for financial services, you would go to a financial service provider like a bank or an insurance company. If, for example, you wanted to purchase something, what you would typically do is you would go to a bank, open a bank account, your salary or however you make money gets credited into that bank account, which then gives you a debit card or a credit card on top. And then after that, you could go to the market and you could buy a cup of coffee or you could buy a laptop and you could essentially pay using the payment instruments that have been provided by the financial service provider. Same example in lending, if you wanted to, let's say, purchase a refrigerator and you didn't have enough money, you would first go to a bank where you would get a loan. And then separately, you would go to your mall or your market and you would use the proceeds of that loan to buy the fridge. And so the financial service provider would always have a utility function. It would be a service provider in the pathway of servicing a need. But your end need, which is buying a refrigerator or having a cup of coffee, would be provided by a coffee shop or would be provided by an electronics market, or in the case of online purchase, would be provided by a platform like Agoda or Amazon or eBay or Lazada, right? Embedded finance sort of upended that model, and embedded finance took out the intermediary and essentially embedded the financial service at the point of end need. So, for example, if you as a customer want to buy a refrigerator online through an e-commerce platform, you essentially can go to the platform, which might have the ability to pay for that refrigerator using installments through a buy now, pay later solution, or it might just give you a credit limit issued on that platform, which will allow you to purchase the refrigerator today and get a loan on the side on the platform, which can be repaid with interest later. So essentially, it's providing the financial service at the goods service provider at the point of context where you are servicing your end need, rather than having to go to a bank or a financial service provider before you went to the market. If you think about it, it really changes the model a lot because the user experience now is for the financial service is also controlled by the platform that provides you the good or service. It also means that financial service providers become more of a B2B provider, where they provide the back-end financial service to the platform rather than own the relationship with the customer. And that's essentially what embedded finance is doing. And that's essentially why it's becoming big. Putting this into context again, historically, so if you look left to right, across time, starting from the left, if people wanted to engage a financial service, they would back in thousands of years ago would typically go to prototype banks. So prototype banks, for example, would be temples. The temple of Athena, for example, was known as a place where you could engage in financial transactions, especially if you were a trader or a merchant. And so the temples served as the intermediary that would provide the financial service, and then you would go to the market to trade, to buy wheat after you had gotten a trade instrument or had exchanged the money that you wanted. Then across time, you eventually had the emergence of banks, starting in Northern Europe and then eventually going across the world, where the banks provide you checks, letters of credit, cards, ATMs, in certain cases, more digital payment methods like QR code. And then after that, you would go to the market. But now with embedded finance, essentially you just need to go to the market. And as you're engaging in commerce or consumption, the financial service is embedded at that point of need. So hopefully this gives an overview of what seems to be changing in embedded finance and why that is a seismic change versus what we've had across the previous decades and centuries. So moving on, what I decided to do after that was, before I began my research on embedded finance, I decided I'm going to try and produce a more holistic, consistent, and academically usable definition of embedded finance, so that A, it could help me in my research, and second, that perhaps it would provide sort of a guidance for other researchers as well as practitioners on how to look at embedded finance. So I won't go through this list, but the main thing I wanted to point out was that there's a lot of definitions of embedded finance out there. Most of them are in gray literature, and many different sources look at this through different lenses, and then there's a couple of different nuances that come in. So after looking at everything I could find in gray literature, industry practitioner research, as well as whatever references I could find in academic journals and books, I found out that you could put most definitions of embedded finance into 4 schools of thought. And I tried to summarize what I found. So school 1, which was, the initial definitions of embedded finance as this was coming up, most of the definitions that you can put in this bucket, they look at embedded finance as non-bank third parties providing financial products. What does that mean? It means financial products are being provided by entities that are not banks. And a good example of this early on was the likes of Ali and WeChat. Ali and WeChat, for those of you who are unfamiliar, emerged in China, and they really helped the Chinese sort of payment fintech market skip the typical trend of payment and fintech development. The typical trend is if you're a market, you're probably trading in cash, you buy stuff with cash. Then eventually banks start to introduce credit and debit cards, and the card penetration goes up somewhere about 80-90%. And when most of the market starts to get carded, then you start moving into digital payment methods like wallets and account to account transfers and more of what open banking is trying to do. What Ali and WeChat did was they, as 2 sort of super apps, helped China skip the card bit. So China never really got the amount of debit and credit card penetration as was expected of pretty much every other market, but they single-handedly shifted the trend towards e-wallets like Alipay, like WeChat Pay, where people would essentially put money in a closed loop environment and then they would be able to go to any place across China pretty much, and they would be able to scan a QR code and make a payment through their e-wallet without ever having touched a debit card, without ever having touched a credit card, without ever having even walked into a bank to open a bank account. And so in that instance, they skipped the middle layer, and then eventually they started offering solutions like borrowing. They started offering solutions like investments. In fact, Ali found that they had so much cash left over that they were able to put it together as an investment solution and made what became the largest money market fund in the world. So here's an example of non-bank third parties, essentially super apps, providing deposit services, payment services, investment services. And so that essentially is what School 1 is talking about. School 2 added a bit more nuance. So it said that embedded finance is non-bank third parties providing financial products, which they provide on their platform through a bank or fintech. So it's a bit different in this case. What this school says is that platforms, e-commerce companies, for example, providing financial products on their platform with a back end serviced by a bank or a fintech company, like a license or deposit taking technology or credit scoring technology being provided by a formal bank, that is essentially embedded finance. So examples of that would, for example, be a platform like Apple offering an Apple Card, which is something that was done in North America. And Apple, being a platform, essentially ended up offering credit card services. But they did it in collaboration, and they, of course, are a technology company, so they can build the tech. But they did it in collaboration with Goldman Sachs, which is a financial services company, which had licenses to be in this space and also had capabilities for underwriting and card issuance and distribution. And so that's an example of a platform like Apple offering a financial service through a bank. And School 2 definitions essentially fall in that category. School 3 essentially said that it's not just sufficient to offer financial services on a platform, but that the reason this has adoption in consumers may be better than what banks and fintechs are able to offer is because it offers improved user experience. So user experience improving through financial services being offered on digital platforms became a core part of the definition for School 3. And if you think about it, it makes intuitive sense. If there is no improvement in user experience, or more importantly, if the user experience is becoming more adverse than, let's say, using a fintech or going to a bank to get a financial service before you come to a platform to buy something, then not a lot of people are going to adopt it, right? So it's very clear that by removing the friction that banks and fintechs sometimes bring in, or removing the extra steps that have to be performed to access financial services, and just embedding it at the point of context at the digital platform is probably what makes embedded finance, and it's probably what drives adoption a lot more. And so these set of definitions focused a lot more on user experience. And then the fourth school is sort of more in tune with the topic of the session, which said that it's not just that user experience should improve by offering financial services on the platform. The definitions in the fourth school essentially say that the financial product should be so naturally integrated to the point of being invisible. Now, what that means is that when you go to a e-commerce platform and you're buying, let's say, a refrigerator, the financial service that you get through embedded finance should be so natural to the act of purchase of the refrigerator that a customer doesn't even notice that they're getting a financial service in addition to buying the consumption good that they're after. And some good examples of that were started to come initially from the ride-hailing industry. So Uber was seen as a pioneer, and in Uber, or now in Grab in Southeast Asia, or Lyft in North America, if you ever used it, you would notice that a lot of people, what they do is enter their credit card and they save the card on file with the Uber, so that the next time they order an Uber or a Grab, They get into the car, and as they get out of the car, they close the door, and that's payment done. Now, you haven't had to key in a credit card number. You haven't had to take out any cash. You haven't had to open a third party app to scan something and transfer money. You open the door, your service started. You close the door, automatic payment done. You have not had to engage with any kind of a special financial service. And so that payment instrument is naturally embedded into the act of taking a ride to the point of being invisible. Of course, until you see your credit card bill, but you get instant gratification without having to necessarily notice that you're also getting a fancy product on the side. There's other examples of this from a lending perspective. Initial buy now, pay later companies looked at the same model, and the Klarna's initial model, for example, in Sweden was as you go to an e-commerce company and you buy some kind of online, you make some kind of an online purchase. You just press checkout. You just have to choose that I want to pay in installments, and you press checkout and done. There's nothing else that would happen. You would get your purchase delivered to you, and a week later you would get a separate instruction from Klarna that this is how your installment plan would work, and across the next month, please make this payment, and then this payment, and then this payment. And so again, there was a installments based lending service embedded into the checkout page to the point of being invisible at the time of checkout. And so the fourth school focused a lot more on the invisibility of the financial services provided on digital platforms. So that's what I found from literature. And I thought that I needed a more consistent definition for research purposes that would embody the best aspects of these schools. And so I came up with this definition. And so my definition became embedded finance is defined as financial products and services. So payments, lending, trading, investment, deposit taking, credit card, insurance, etc., offered directly by non-finance companies or in partnership with traditional financial institutions and fintech companies. So it's taking both the elements of school 1 and 2. A platform could offer it directly without partnership with a traditional institution, which means they have to get their own licenses, which means they have to build their own tech. And examples of those are Ali and WeChat, for example. Or they could do it with traditional financial institutions using APIs, using banking as a service and open banking rails. And they could essentially just own the customer journey and the user experience part and the branding of the service, but someone else, a more traditional financial institution, could provide the technology and to some extent the licenses. So offered directly by non-financial companies or in partnership with someone at the point of context on digital platforms and applications where users organically congregate. So it's important that these have to be offered at the point of context, which means typically on platforms where you go to fulfill an end need, typically embedded somewhere in the checkout pages of those platforms with improved user experience at the core of the proposition. So it has to result in some improvement in user experience from just using a fintech application or a bank application, ideally naturally integrated into the product or service to the point of feeling invisible and seamless. So what this definition therefore does is that it takes the best elements of the four schools without building any exclusions in, and it looks at most of these providers as being embedded finance providers, but falling on a spectrum. And the spectrum is defined as EF 1.0, 2.0, 3.0. So if a digital platform is providing a financial service at the point of context, but it's not necessarily improving user experience, that's still embedded finance, although it's at the low rung of it, probably EF 1.0. If it's providing a financial service with not many clicks and without redirecting to a third-party platform, that's probably a bit better, and it's falling in EF 2.0. And if it's so naturally integrated that you don't even notice the financial service and the brand and the user experience is owned by the platform to the extent that customers don't even know that they're getting a financial service in addition to the good or service that they're buying, then it essentially reaches the best level of embedded finance. And it's a journey that improves UX consistently for the user to the point of making it naturally invisible at the highest level. So that was my definition. And from here, now that I had a definition, I decided that the natural point to focus on for research is user experience, because what became clear from my initial research is that it's not just that products and services, financial products and services are being made available at the point of context on digital platforms that's causing so many customers to adopt it. It's because they are getting a good user experience. And without that user experience, there might not be as big an adoption for embedded finance as we've seen over the past few years. So my research, therefore, sort of started to look at the user experience aspect of embedded finance. And I sort of classified this into two buckets: the technical improvement in user experience because of embedded finance, and the perceived improvement in user experience that a customer might subconsciously or very consciously notice. And so what I ended up doing was producing some hypotheses using these two strains. So for technical improvement in user experience, which is the box at the top left, I drew from the field of human-computer interaction, where there's a lot of research on usability, which looks at technical metrics like number of clicks to complete a task, task duration, how much time it takes to complete a particular task, and of course the completion rate, how many individuals actually engage with a particular online product before they start to give up. And given the strong research on those three, I decided that I would track improvements in user experience through the usability construct, and using these three technical parameters to measure how embedded finance services improve experience. And then from a perception perspective, I drew from the field of information systems using a very, very popular theoretical framework called the Unified Theory of Acceptance and Use of Technology. The second part of this focusing on consumer adoption of technology, whereas the first part focused on professional adoption of technology. So in this, I looked at what does the consumer feel when using embedded finance versus traditional financial products in terms of the performance of the product, the effort that the user feels is going into engaging with that product, the facilitating conditions in terms of is it online, is it on the app, is it on Android, is it on Apple iOS, as well as the innovativeness of the people that are engaging with this and their perceived security of engaging a financial product with what is ostensibly a digital platform providing goods and services, and whether they trust that platform to provide such a sensitive service, which engages with money and requires a lot more personally identifiable information. And I linked that to the behavioral intention to adopt the technology, in this case, embedded finance, with the use of age, gender, and experience as control variables. And so that essentially became my model. And as I got to that stage, we decided that we would publish our thoughts on the definitions as well as the user experience aspect of embedded finance, which is what you see in the book. So if you get an opportunity, do read the chapter in the book. I think you'll get a few more insights. And also there's some chapters on buy now, pay later and other embedded finance products that I spoke of, which should give you a good idea. The next step in our research is to try and move forward with some data collection and validate some of these hypotheses and see if we can get some interesting learnings on this. I will pause here. I think that's a lot of information to take in, and perhaps we can open up for some questions. Dr. Tibai?
Hello. Yes, sure. You can put questions in the chat, or you can just raise your hand and speak. I don't know. Maybe one thing where we go now, and what is your take on the development of embedded finance or in general? It has come quite some time. I think this year we have the 30th anniversary of the famous quote, banking is necessary, banks are not, from Bill Gates. I think he firstly stated this in 1994. So it's this year, 30 years, and we still have a lot of banks around.
Indeed. So I think it's been a journey, and there have been many nuances in that journey. I think for those of us in the industry, in the fintech industry, you do see some of the changes coming around. So banks have been resilient to the extent that they have tried to become partners with online platforms or offline platforms so that they are able to get technological learnings and essentially become, if not the front end, then the back end providers of financial services. So a good example, for example, would be banks like, I guess I can say that not in the industry, JP Morgan, Deutsche Bank, HSBC, Standard Chartered, Citi. If you go to their websites, or if you follow their fintech initiatives closely, or you follow their fintech acquisitions closely, what you see is that they are investing a lot in banking as a service technology. So they see the threat that customer experience is being taken away by these digital platforms. So what they're trying to do is get ahead of the curve, establish good APIs, get decent technology, which can then be used to offer to these digital platforms so that they can offer banking services on those platforms. So that's one way that banks have tried to keep themselves relevant. The other aspect is, if you look at some of the industry forums like Money 2020 or Singapore FinTech Festival or Merchant Risk, I think conference is what it's called. More and more, if you go to the booths of the banks in these important fintech conferences, they're focusing a lot more on establishing those back-end rails rather than continuing to own the customer experience from a retail banking perspective. And they're trying to retreat a lot more into corporate banking, where they still have a niche, because business to business banking is not necessarily done on an app, or it's not necessarily something that can be easily embedded into an online platform, because the nature of the B2B industry is different. But B2C, you can increasingly see that banks are starting to give up space to these more nimble or online platforms. So is it there yet? No. Has it taken time? Yes. Is it now at an inflection point where disruption is going to be a lot faster? Yes, I think you can see in the numbers that it's with the revenues expected to more than double in about 2 years. It is now going to become a lot more visible going forward.
So you think it's accelerating? We have here another question in the chat. When the payment aspect is also handled from the same business platform, how would the security challenges and related costs be addressed?
So I'll divide that into two. On the security aspect, so there's two ways that payments are handled by platforms, right? One is the platform could essentially become a payment provider itself, and some of them do that, like for example, Ali or WeChat Pay. And they are now approaching, I think, their, I don't know, 12th or 13th anniversaries. They process hundreds of billions of dollars, and there's a lot of people, for example, in China who would not even have a bank account. So they don't trust banks, but they would have a Alipay or a WeChat account, and that's what they use to not just transact, but those are super apps that they use to buy groceries, to make hospital doctor appointments, to share the most sensitive of sensitive data. So what that should tell you is that technology companies over time are able to create a lot more trust than, for example, banks are able to. And that shows in the adoption rate. With regards to platforms that are earlier in the journey, or for example, that want to process cards, they have to go through some steps. So, for example, they have to be PCI compliant, payment card industry standards, which are security standards, which require you to store data in a certain manner, and you get audited, and you can lose that certification if you don't pass an audit. And so you'll see pretty much every major platform that handles payments is PCI compliant at the highest level, at the same standard that banks are. So it sort of helps them come up the curve on the security aspect. Sorry, I missed the second part of the question. Could you repeat?
The related costs, how the related costs will be addressed.
So a lot of platforms look at providing payment and embedded finance services not as a cost center, but as a profit center. They see this as a way to essentially either cut their existing costs or even to start monetizing. So, for example, if you look at an embedded finance solution using buy now pay later for lending, a lot of platforms are able to use that to upsell products. So let's say think of Amazon, right? If you're buying, something, if you're buying a television for 32-inch, and if you get given a promotion that, hey, just for $1,000 extra, which you can pay across a 6-month period, you can have a 50-inch screen. You'll probably think about buying the 50-inch screen. And what's the platform done? They have suddenly increased the ticket size of the cart. And so for all the purchases that are made through buy now, pay later, they're able to justify that effort through higher sales on their platform. Others, for example, take the knowledge that they get from handling their own payments to start offering payment services to others. A good example is virtual credit cards, where a whole bunch of platforms are now issuing their own cards and actually compete with banks. So it's seen as a profit center for a lot of platforms rather than a cost center.
I see. You mentioned one aspect that might be interesting, that now these services are also used from people that don't have a bank account. That might raise the question on the topic financial inclusion. You can offer services to people without bank account, but the other aspect could be if you have embedded finance included, do you also see the risk that the digital divide actually gets bigger and some people might be even excluded from some services because they might not qualify for the financial service that is embedded in the product? What is your take on the benefits and risks in this context?
Absolutely. So again, I'll divide it into two, the benefits and the risks. So as you rightly pointed out on the benefits, this is like spectacular for financial inclusion, because by removing the friction towards engaging in financial services, by making it easier, 1 click, 2 click to get payment services, access to capital, or investment services or saving services, it essentially improves financial inclusion, especially in the more emerging markets and developing markets. And as we saw in China, right? So with Ali and WeChat, they got greater retail penetration eventually than some of the big banks did. So for financial inclusion, it's awesome. I don't know how many of you have been to China, but when I landed in Shanghai back in 2019, I could not pay for anything other than my hotel because no one accepted a credit card. Even a fruit vendor just selling fruits on a cart had a QR code with Alipay and WeChat written on it. And even that vendor was able to access Ali and WeChat services through their app on their mobile. And they were able to therefore expand the payment options available beyond just cash. So no one took cash, no one took cards, and you could hardly operate in a city like Shanghai if you did not have Ali or WeChat, which tells you something about their pervasiveness and how easy they made it. But on the flip side, yes, there's always going to be segments of the population and segments of the market who will not benefit from this, who might not be digitally savvy or technologically savvy. And by essentially providing technological solutions or otherwise, it makes it harder for them to access those services. I think that is a genuine challenge, and oftentimes it's a bit difficult for those challenges to be addressed by companies like this. Regulators, central banks have an important role to play there, and I think you see some of the regulation evolving where they're trying to make sure that some of these new solutions that come in are able to service more exposed sections of the population. One of the ways they're doing it is by trying to bring in some of these same solutions offline. So buy now, pay later is no longer just something that you can get at online platforms. You can actually get it at physical stores. And as this goes offline more and more, it's supposed to provide better accessibility to a wider section of the population that might not be completely there in terms of digital adoption. Is that perfect? I don't think so. I think there will be a journey, and probably the regulators would also have to step in to make sure that this part of the market doesn't get missed.
Yeah. We have also some comments in the chat, but maybe first to Gunnar, because he raised the hand.
Thanks.
Please,
Thanks, Jibran. Nice, very good presentation. Very interesting to learn something new, kind of collective way of looking at what's been happening over a long period of time, and how you kind of combine that. I have a few questions. Like one of the earlier slides, we were looking at, for example, how you kind of like remove the finance provider, the bank. And at first, initially, I thought that was like actually what the embedded finance was. Then you kind of like left it out, but I understood later on in your presentation that you actually, in many of the cases, you still keep the financial services provider. And, you might, as you said at the end as well, you might take it in as has it under your own company, like a lot of companies do, for example, providing insurance products or payment services and so on. But anyway, what I was wondering is like, how do you see crypto fitting into this? And how would that kind of like remove the need for financial service providers? I have a couple of other questions as well, but we can just start with that one.
There's always a crypto question when you talk about the fintech. So I was waiting for that. No, I think it's a journey. I think, crypto has had a fairly volatile path towards today, although, it seems like it's getting a bit more mature. Now, from a crypto perspective, of course, there's the obvious theoretical aspects, right? So if you're talking decentralized ledgers and decentralized payment methods, then essentially you're already cutting off the financial service provider, which is great in theory. And from that perspective, crypto is supposed to accelerate that. You can start using, if you hold crypto and you're able to, and a digital platform is able to sort of embed that, then essentially it's adding to the payments leg. Or you could also start lending through crypto solutions, or you might not even need any kind of financial service provider, including a central bank, because a platform could just launch its own cryptocurrency, right? And they could essentially, as a lot have tried, use tokenomics to build a sort of, self-sustaining flywheel around that crypto coin, and benefit both in terms of reducing payment cost, as well as improving, the ability to pay, but also benefiting from the capital appreciation that comes with the price of that crypto going. So a lot of companies looked at that. I know I looked at that. At some point, we thought, let's just launch an Agoda coin, get everyone to pay in our own Agoda coin, and Agoda coin will become valuable, and we will make money by Agoda coin going up rather than, something different happening. And thank God we didn't, because the NFT market crashed and we ended up, saving some money. So I think it has a role to play. I think the practical manifestation of that still has to sort of, produce itself at scale, because while crypto can be issued by everyone, there isn't a clear payments use case at the moment, other than gaming and maybe, retail fashion. Also, like even with the launch of central bank digital currencies, etc., what seems to be coming out is that you do need a provider somewhere to push consumer adoption and improve the user experience. Central banks can't do that. And it's something you see with the card market and the wallet market, that you need an issuer, you need an acquirer, and one needs to push the consumer adoption and the other needs to push the merchant adoption. Otherwise, you have a whole bunch of crypto holders who don't know where to spend it because the acquirer hasn't gone ahead and acquired merchants, or you have a whole bunch of merchants looking to accept, but there aren't enough issuers pushing customer acquisition. So from my perspective, I remain neutral to bullish on crypto. I think it has a role to play here, but I think it's going to take some more time. Hopefully I've answered your question. If I haven't, feel free to drop me a follow-up.
Yeah, definitely. Just following up on that, you mentioned that Go.com and so on. I'm just like curious if you like the ideal embedded finance would be human capital in transaction towards like services or goods. So you kind of like exchange your human capital as work or whatever you do, and you kind of like exchange that for services or goods. Is that the like ultimate level, or?
So that would be the ultimate level. Right now, I think people aren't dreaming that far. I think right now the ultimate level that's seen is think Alexa, think Google, the voice activated thingy, think the Apple. So basically, the ultimate thing that's seen as one day you wake up and you say, "Hey Google, open an account for me in." No, hey Google, I want to purchase a refrigerator today. Please set me up for something delivery tomorrow. And Google responds to all sorts of APIs. I opened a bank account for you with X. Well, I opened an account for you somewhere which is costing you $2 less, and I saw your wallet didn't have enough money, so I looked up all the good loan providers out there and got you $1,000 loan, and I've used that to transact on the platform. And refrigerator is on the way. Your payment schedule is now in the app. Right? You just said I want a refrigerator, but everything else has been delivered at the back end through APIs. That's the ultimate piece. The ultimate would be, yes, maybe don't even have currency behind it, but actual, human resource capital behind it. But I think it'll take some time. As a practitioner in this field,
from this,
it's far away.
because crypto is obviously a big topic, and in our book, Digital Project Practice for Banking and Fintech, we look at this from different angles. And just last week, we had a webinar with Dr. Mark Nahtman on the topic of blockchain and cryptocurrencies from a perspective of a bank, because he is from ING Bank in the Netherlands. And there we also discussed a little bit about how the bank stays relevant in this context. So feel free to reach out, and we have a recording of this webinar on YouTube. So there's also, from a different perspective, from the bank's perspective, how to stay relevant, some takes on this. Maybe to go, you have another follow-up question? Short?
Yeah. Have a couple more if that's okay. So I was wondering, is like, since you're looking at the UX part, is like, have you found any way that when you're improving the UX, that it kind of like you sacrifice on security in any way, because that's usually the issue with the user experience that and the security, especially with payments, that you have to go through multiple steps and use external devices or whatever to kind of like verify who you are. Have you seen that, when you get this more embedded, that's kind of like sacrifice on the security side?
It does to some extent. So I'll speak from a platform's perspective, right? So one of the major challenges that platforms face is what's called friendly fraud. So essentially, someone using someone else's payment instrument or card to make a purchase, and then that person coming back and claiming the money back through chargebacks, etc. And it's a common problem with every e-commerce platform, right? And a certain percentage of revenue of every e-commerce platform is lost because of friendly fraud. Now, that's where the authentications you're talking about, two-factor authentication, what's called 3D secure or 3D secure 2, those kind of standards come in, where you have to provide some kind of verification. And the trade-off is that, of course, it adds friction to the process. And friction is precisely what embedded finance is trying to remove by improving user experience. So yes, there is a trade-off, no doubt. But what platforms, so two things are happening. One, what platforms do is look at the improved conversion rate versus the higher friendly fraud rate. And if the equation points towards greater incrementality from the improved conversion rate, then you're already benefiting from offering a more frictionless solution, unless regulators mandate. And in certain cases, for example, European regulators want 3D secure 2, and so you can't really get away with that. But in Asia, you don't. So there's a trade-off, but by and large, for most platforms, that equation is positive. Second, as the user experience is getting better, a lot more is getting done on making the sort of the authentication part a bit more seamless. So, for example, I don't know how much you know about payments, but one of the big themes that was introduced is called tokens, tokenization. So if you believe Visa, they now have more tokens in circulation than actual credit card numbers. And what tokens do is essentially they add a layer of security where what platforms are storing are not 16-digit card numbers, but encrypted token numbers, which even if compromised, don't actually get the credit card details of the customer released. And so in a sense, the industry has responded to the security needs while realizing the UX improvement benefits of lower friction. And so it's started to catch up. Hopefully that answers your question.
Absolutely. Thanks. Just my last question, since you work at Agoda, I was kind of wondering, is like, how do you see you working at Agoda towards embedded finance and towards like embedded finance 3.0, 3.0? How do you see that way moving forward?
Oh, I think it's not just about Agoda. I think like if you talk to any major online travel agency or e-commerce platform, I think they will probably all talk about similar themes, right? So one big theme is one-click checkout. The customer just lands on the checkout page, forget friction, they don't have to enter anything, click, checkout, purchase, and every security, compliance, or economic consideration just embedded into that one click. It is a dream. Not a lot of companies are able to do it. Ride-hailing is able to, food delivery is able to do to some extent. E-commerce is getting there. Some have gotten there. Others are trying to get there. And I think a lot of them are going to get there. The technology and the infrastructure is getting there. I think the other major thing that you'll probably see is interest rates have gone in the other direction. But I think once interest rates come down again after the cycle sort of normalizes, you see a lot more loans getting disbursed on platforms than, for example, what you would get from retail banks or fintech lenders. And I think the third major thing that to expect is that not only will the e-commerce platforms, I think, start to offer financial services on their platforms through others, but they might even decide to become financial services providers themselves, offering those services to other e-commerce platforms, embedding it into their platforms. So banks might even see the B2B space start to get a bit disrupted.
And they might become a bit more of a commodity. Then maybe to the comment that we had in the question, because we reached already a bit of our time limit, where the comment in the chat was, from my understanding, it looks to me that the future of digital technology platform will be evolved around non-bank B2B players, such as offline and online point of sales. The balls will be in the hand of a tech firm through supermarket, and merchant itself. It means banks' technology will have to be distributed at the point of sales in the end marketplace, so no longer at bank environments. On the other hand, that puts the question to whether the merchant has the capability to control the security challenges.
So there's several aspects there. Maybe I can summarize it. So I think, yes, increasingly, as I mentioned, the user experience is going to be owned by platforms. And if you think about it, it fits, right? When you wake up in the morning, how many times do you open Facebook, Instagram, Lazada, Shopee, Grab? And how many times do you open a fintech or bank app? One is need, the other is tech companies are simply good at tech and banks are not. Banks are good at compliance, regulation, security, and of course, underwriting and making money move across borders. So that's why banks have taken on more of a B2B role, and they are increasingly surrendering the front-end customer journey and customer experience and owning the customer acquisition to tech companies and platforms. That does mean, yes, tech companies will have to step up on security, but they already manage all kinds of PII data. They oftentimes manage it better than banks. If you look at all the fines that are made for data breaches, the fines that are put on banks are much larger than any tech company. And so the expectation is that tech companies have the capability to do it. A lot of them are already doing it, and it's not necessarily going to block them towards owning more and more of the customer experience and taking over more and more of the customer journey. I hope I've answered your question. If I haven't, I'm happy to take a follow-up.
Sure. We already reached a little bit the time limit. Thank you so much for your insights and sharing it. Follow-up questions, I would encourage them, join our group and this discussion on various aspects on embedded finance, on crypto.